to do something a little bit closer and about the same size. I don't know what happened there. Okay, there we go. We'll put in $50, and we want the miss because we're saying that price is not going to get into that. But look at this. What's the payment? Well, hang on. Let me adjust this. Okay, so July 11th at midnight to August 11th at midnight. What is this telling us? That we'll lose 48 cents. Guaranteed loss right there. Why? Because the broker is saying, man, there's no way price is going to come down there, and I'm going to charge you 48 cents just for placing the order. That's what they're telling you. Okay? So the only way to really adjust this, putting more time on there, that might work. If we went out to the maximum time, but really the big difference is going to be the price. So what I'm doing here is moving the top of the box closer to the current price. Okay, so you can see here, let me move this across. The euro is trading at 37.69. And you can see that I've moved the top of the box to 35.72. So basically this is saying for a month, the euro is not going to drop more than a couple of hundred pips. Okay, that's what that box is saying. Let me move that out of the way, and let's kind of move this back and see if there's any reason for me to put a box there. Remember, you don't want to create an option just because you make a certain amount of money. That doesn't make any sense. That's like, I've been getting questions about the whole 2-to-1 risk-reward ratio. I might have said this in one of the prior videos, but it bears saying again, you don't want to make a trade just because you think you can make 2-to-1, or you can make 3-to-1, or you can make 5-to-1. You have to see, is there a reason? Is there a reason for price to stay above that level? And the only way to do that is to look back here. And you know what? Maybe. I mean, there is some consolidation in that area, but really the ideal would be to place it a little bit lower, which would be more in this area here. And we'll go ahead and compute it, and you can see, once again, they're saying, yeah, you know what? It's pretty likely the price is going to stay above that level, so we'll give you $4. 486. 486 divided by 50 is 9%. So we'll pay you 9% on your money for the month. Okay? That's not bad. As long as the option stays above 34.78. So again, you can make that decision for yourself. Is it worth the 9%? Okay, so what happens if we go to the maximum? Still 9%. But in one case, you're making $4, actually $4.86. In this case, you're making $186.18. But remember, you're risking $2,000. So really, is it worth risking $2,000 to make $186? Okay, that's what you have to decide. It's not about it's not about the return percentage. It's about the risk. You're risking $2,000 to make it $186. Even risking $50 to make $4. You know, you got to think about these things. Don't only focus on what you can make. But also with options, you got to focus on what's the likelihood. So it's a combination of, am I willing to risk $50 to make $4.86 based on where price has to move? Now you could go even a little bit lower. You may not be able to see this, but there's some support a little bit lower. So let's go ahead and set it down. We'll move price below that level. See what the payout is. Now it's $1.65. Okay, so now the broker's saying, come on. You know, of course, there's a very low chance that the market's actually going to move down there. So come on. We'll pay you a little bit. Okay, so you take this, $1.65 divided by 50 is 3%. So we'll pay you 3% on the month. Okay?